In this video, I'll discuss how the shareholding of a company evolves from a startup all the way through to a public listing on a stock exchange, which is also known as an initial public offering or IPO. I'll explain what some of the jargon means and hopefully demystify some of the concepts. So let's enjoy the video together. To illustrate this journey, I've used the data of over 700 IPOs in my charts. Now, our journey begins with two partners starting a software company who have equal shareholding and self-fund the business. However, after a few months, they run out of money and need a cash investment to employ more coders in order to grow their business. They apply for a loan at a bank, which is rejected as the business is a fledgling startup with no positive cash flow. Now, the only option left is to approach a wealthy individual known as an angel investor to invest in their business. One of the key benefits of an angel investor is that the founders are not required to repay the investment amount, and there are no interest payments either. They are required, however, to give away a portion of their shareholding, which essentially amounts to future profits. A typical shareholders breakdown for the angel investor stage looks like this. Experienced angel investors know what the optimum shareholding allocation would be in order to keep the co-founders motivated while covering their own risk. Around 10% of the shares are usually set aside to entice employees to join the company. A small percentage, usually 5%, is set aside for advisors, typical influential individuals who lend it credibility to help open doors for key decision makers. To ensure that the employees remain committed to the business, their shares are vested. This means they earn ownership of their shares over time. A typical vesting schedule looks like this. In this example, 1 million shares are vested over 4 years with a 1-year cliff. This means that if the employee leaves the business within a year, they do not receive any of the shares. And if they leave after 1 year but before 2 years, they only receive a quarter of their shares, which in this case will be 250,000 shares. The employee will only receive the full balance of their shares after 4 completed years of employment with the company. In our example, a further year has passed and now the business requires another big cash injection to maintain its growth trajectory. The investment amount required is too big for the angel investor, so now we enter the world of venture capital. These are firms which invest other people's money in promising new businesses. Venture capital firms usually invest in stages known as rounds, for example, round A, round B, C, D, etc., with each round requiring a larger investment. This chart is a typical ownership breakdown of round A venture capital. In my example, some of the money was used to buy out the angel investor, while the balance was spent on growing the business. This is unusual for a venture capital firm to buy out an existing shareholder, as they would prefer to spend the money on growing the business. To do this, they authorize new capital and issue these shares to the VC firm. In practical terms, this means that the money flows directly from the VC firm to the business. This is different from buying out the angel investor, as the money is paid directly to the angel investor, who exits the business with his share of the money with no benefit to the company. Let's fast forward to round C, and you can see that the VC firms now owns the lion's share of the company. The VC shares are almost exclusively preferential shares, which means they get priority payout in case of liquidations, as well as dividend payouts, and automatically convert to ordinary shares at the time of the IPO. The founders have ordinary shares, which means they have the voting rights to control the company. This line graph illustrates the change in ownership for each of the VC investment rounds. You can clearly see how the founder's shareholding in orange reduces. The final stage of the evolution of our company is the IPO, which is when usually around 30% additional shares are created to sell to the public. These shares are underwritten by an investment bank, which guarantees the sale of the shares at a set price. This safety net comes at a price, as the investment banks charge between 3.5% to 7% per share, which can be very expensive for the company. It also means that the founders' shares are further diluted, as well as their voting power. To counter this, companies like Facebook and Google created Class B non-listed shares. which has 10 votes for every 1 share, and this allows the founders to keep voting control of their company. The following graph does show that despite the dilution of the founder's shareholding, the overall value increases exponentially from inception through the funding rounds all the way to the IPO. It is common to restrict the founders and the VC firms from selling their shares for a period of 6 months after the IPO. This safeguards the market being flooded with their shares and lowering the price. There are some critics of the venture capital industry who argue that the company valuation methods used by the VC firms are purposely overvaluing companies. This is because many companies are valued at hundreds of millions of dollars, while in reality they have negative cash flow and no profit. It is argued that the reason for this overvaluation is to ensure additional funding rounds, which keeps the business afloat, while the VC firms earn management fees. Now, this has resulted in some market commentators calling the VC industry a Ponzi scheme. So there are other options available for companies to raise money from the public, such as crowdfunding, direct listing, and special purpose acquisition companies. But that is a topic for another video. I hope you found this interesting. So as always, remember, we are here to help.